Great to have you back, Lori. Welcome.
Thanks for having me.
You got to feel pretty good about the range you've given the year so far, right?
Yeah, so look, we've said all year, and first of all, our target was 4,100 for most of the year. We revised it up to 4,250, but we've said all along we could see upside to sort of that 4,600 mark, 4,400, somewhere in there. We have basically three models that are kind of cautious and three models that are really bullish, and 4,250 is right in the middle. I put out a piece a couple weeks ago saying, like, these are the top 5 charts that kept us constructive in the first half of the year. One of those is starting to get a little bit worrisome. It's not quite flashing red, but it's starting to flash yellow, and that's our sentiment model.
So describe that. What's your calculus in terms of how it may or may not move your model from here?
So it's the AAII net bull bear indicator. Everyone on Wall Street watches this, okay? There's a reason we all watch it, and it's a very reliable indicator. You want to buy the market when you're at minus 10% or more in favor of the bears, and that's where we were to start the year, and that's really where we were after SVB. But recently, it's been hitting around 20% in favor of the bulls. Now, when you start to hit 30% in favor of the bulls on a 4-week average, you basically get a flat market over the next 12 months, and it's 50-50 as to whether or not you're going to be up or down. So the fact that all these investors I talk with are kind of begrudgingly getting pulled on board with this rally, I wouldn't say they're bullish, but they're losing their bearishness. That's taking away one of our good signals. Other models are still constructive, though.
They're losing their bearishness finally. I mean, after a rip-roaring first half of the year, I imagine that most of them are underwater. I mean, how much of this sort of pressure factors in? Because you have a whole other host of investors who may have called this perfectly and are saying, you know what, this gain for the year, I'm done.
So it's interesting. I talked to one person I know that was caught kind of flat-footed by this move in the first half of the year. I talked to him a couple weeks ago, and he said, we're going to have to start going to all these meetings soon, talking about our second quarter performance, and it's not going to be fun. Just, really dreading it. And I think there are a lot of conversations like that that are starting to happen around Wall Street. Why did you miss it? And a lot of my conversations with investors have been, this market's been resilient. Why? Explain it to me, because they're having to get ready to go out and answer those questions to their clients. So I think it's tough.
So what do you tell them at this point? I mean, you can say the sentiment indicator indicates this, but yet you have a lot of other points in your note indicating that companies are better off, that management teams may be better equipped to handle crisis, that cash in the balance sheet is good, debt is there, but it's long-term debt. So how do you weigh these factors?
So basically what I tell people is this market is not crazy. It's been quite rational. We're here for good reasons. Some of those reasons are still intact. Some of those reasons are starting to break down. It feels to me like we're a little bit murkier tactically. But I've also told people, look, if we end up at 4,600 at the end of the year, that's the tip top of our bull case. We're not going to sit here and say this market was crazy in the second half. I'm going to say shame on me. I should have paid more attention to my more constructive models. That's our valuation and earnings model, by the way. And we've told people, we have to watch this sentiment indicator very closely. If I say talk to a client, once a quarter, right, and I'm talking to them now, it's probably going to flip to the red by the time we talk again. Now, we'll have to see where everything else is. But I think you just have to take it day by day, week by week. And I think you have to look at sector opportunities, right? So we talk a lot about healthcare right now. There's not a lot macro going on in healthcare. It's cheap, improving earnings revision trends. A softening labor backdrop is good. If we get a little bit of an air pocket, it's going to help you out. Even if we don't get that air pocket, it still looks interesting. So we're trying to help people identify those kinds of opportunities.